Welcome back to Fair Fate Investing. Today we're taking a look at Tesla as well as OXY, big buys from Warren Buffett, and things that I've noticed recently. So the first half we're looking into Tesla, and then the second we're going to be talking about Occidental Petroleum. I'm going to be sharing some fundamentals for both companies, running a valuation, and explaining some things to help you value each business. First, a quick plug. If you want access to my trades, products, and many more perks, check out the link below. So looking at Tesla, the way that I interpret a price to earnings ratio is that it would take them roughly 47 or 48 years at their current earnings to earn what I'm paying for. So just to simplify this example for you guys, if there was a price per share of $1,000 and the company had a price to earnings ratio of 100, that would mean they earned $10 per share. So it would take them 100 years at $10 per share earnings to equal that $1,000 price per share. So that's assuming that the company is not going to grow their earnings, of course. If their earnings were to stay exactly flat for the next 100 years, or in Tesla's case, for the next 47 or 48 years, if their earnings didn't go up at all, then it would take them 47 to 48 years to earn back the dollar value that you're spending per share. And this is something that I've seen widely across the market where companies are trading for price to earnings ratios of 30, 40, 50, 80, 100, or even higher. Just a couple of years ago, they were much lower than that. So it looks to me like many stocks in the market are having inflated values, and it just makes me want to tread cautiously for what I am selecting. If a company like Tesla or Occidental Petroleum or any company with a high price to earnings ratio, and when I say high, I'm considering anything above 30 to be relatively high, it's only high as long as they don't increase their earnings. So if they were to increase that earnings, imagine it like a price, so 187 divided by what they earn equals 47. So if they increase that earnings or their denominator, then it would make the price to earnings ratio lower. But if they don't grow as fast, then a high price to earnings ratio can indicate a severe threat to your valuation and your future returns. So we're going to have to look a little deeper into the price to earnings for Tesla and check out their earnings to see how they're growing and what's reasonable for them. We can see they have a market cap of just under $600 billion. The software is calling out a potential value trap. Not entirely sure if I believe that, but we'll see. We can see they have a cash debt ratio of 2.71, so for every dollar of debt, they have $2.71 to pay down those debts and expand the business. When it comes to their margins, it looks like gross margins are deteriorating. They've had a maximum in the last 10 years of 27, a median of 21, almost 22, and a current sitting just above their minimum. This is a rough market for an electric vehicle maker, incurring high costs, and we see that reflected also in their operating margins, which are still above their median, but deteriorating significantly from their maximum. When it comes to their net margin, though, they're actually just below their maximum for the last 10 years, which is surprising to me. And I'm not entirely sure, just from this glimpse, why their net would be not falling at a faster pace, similar to their gross margins or operating margins falling. When it comes to free cash flow, they have very low free cash flow, 1.46%. I'd like to see double digits, but again, this is an auto manufacturing company, so you're not going to have high margins like a software business would, or a company like Apple, which can charge a high premium for their products. So these margins tell me a little bit about the business, but for management strength, I would use ROE, ROA, ROIC, and ROC. And for these, I'm seeing double digits, teens to 20s, so no real complaints there. And looking back at that price to earnings ratio, we can see that this is one of the lower price to earnings ratios they've had in the last 10 years. So not cheap, but it all depends, again, what you think they're going to be earning in the future. And now taking a look at those financials on an annual basis, we can see that their revenues have seriously increased over the last 10 plus years, and those margins have picked up as well. On a trailing 12-month basis, we can see that up and to the right slope for the revenue. We can see net income positive, although there is a slight rounding. And I am a little bit less impressed by the fact that net income didn't keep rising, even though the revenue rose all the way up until about the end of 2023. So you can see that the net income remained relatively around what it was since the end of 2022 all the way to the end of 2023. So that whole year, their revenues increased, but their net income bounced around and didn't really follow along the trend. And now we see revenues starting to round here, but refining it even closer to a quarterly, we can see it's a little more sporadic. And most recently, they had a really rough quarter for net income, still in the green, but one of the worst quarters they've had since 2021. And they've had roughly double the revenue with even less net income. So that's not exactly what you want to see. They do have a pretty significant cash pile. They have 26, almost $27 billion in cash and just about 10 billion in debts. We can see share sales recently, so diluting that shareholder value by increasing the share float. Another thing that I don't necessarily want to see, as of now, they make just under 94% of their revenues from the automotive segment, and the remaining 6.2% in energy generation, with the bulk of that revenue coming from the United States, followed by other international countries and China. But to get a hypothetical valuation, let's run a DCF. So in the DCF, we can see we have low business predictability sitting at 1 star. There's no annual data for the 10-year average, 5-year average for earnings per share, but we do have a 3-year pretty fast acceleration. And for free cash flow, nothing on the 10, nothing on the 5, but we do have an average for the last 3 years. And looking at earnings per share, for the next 10 years, there's about 33% priced in as an annual growth rate, which is a pretty significant amount of growth, but who knows what Elon has hidden up his sleeve or what his future plans are with robotaxis, humanoid robots, Starlink, and I even think that he could end up selling some of that Starlink satellite internet access to other companies. But my point being, I wouldn't necessarily bet against Elon Musk to have some things hidden that he's going to reinvigorate growth or try and turn Tesla into a larger business than just an automotive. So 33% growth for the next 10 years is a large amount of growth to be pricing in just for the fair value. So if you want the fair value to be even higher, then you're going to have to see much more. And anything less than that 33 would equate to potential downside for a fair value. But again, stocks don't have to trade for fair value because ultimately what a company earns determines what it's worth. I think that very often stocks can trade for a premium or a discount. A lot of people aren't going to value Tesla fairly. They're going to treat it with a premium because it's such a meme stock, and Elon Musk just has that reputation to provide a little bit of shock and awe. And I really do think that in the future, he may add some things such as humanoid robots or some Starlink internet revenues, be it from individuals or companies or even larger businesses or governments. So I think a lot of it is gambling on the idea or making an educated bet on the idea that in the future he will release something else that will reinvigorate that growth and create more of a behemoth out of Tesla. So I think that's what a lot of people are holding Tesla for, but that's the fundamentals of Tesla. Taking a look at OXY. So for Occidental Petroleum, An article just came out saying that Warren Buffett is still buying more shares and increasing his position. At this point, he's got to have at least 25 or 30% ownership of the company. So multiple billions, double-digit billions invested in this company, and it's now one of his relatively large positions. So he's betting a lot of money on oil, namely Occidental. And in doing some research recently, I found out that Warren doesn't usually buy a stock over a price to earnings ratio of 15. And that has to do with Benjamin Graham's The Intelligent Investor, which Warren studied heavily, and in which says that you shouldn't really be buying a stock over price to earnings of 15. But of course, there are exceptions to that rule, and it looks like Warren is making a choice to buy Occidental Petroleum even while it's above a price to earnings of 15. It seems to me that he's expecting the earnings of the company to increase, which would again lower that price to earnings ratio, or some other thing such as a very wide moat or war or something in the future to increase the prices of oil. And Occidental Petroleum also has a pretty advantageous position when it comes to carbon credits, where they have actually franchised a system to remove carbon from the atmosphere and then sell those credits to businesses that use too much carbon to offset their carbon footprints. But however you feel about it, when whales are buying a company, you should at least look into it, especially when the whale is someone as legendary as Warren Buffett. So they have a market cap of just under 56 billion, an enterprise value of just under 84 billion, a very low cash debt ratio with 0.06. So for every dollar of their debts, they have 6 cents to pay down those debts. When it comes to their gross operating net and free cash flow margins, they're sitting slightly above their averages for the last 10 years, but still pretty solid, with a net margin of 16%, free cash flow at 18, operating at 20.5, and gross at 34. Their price to earnings ratio is significantly higher than their 10-year average of 13.2 and that minimum of 4.7 in the last 10 years. So I would be much more interested in buying around the 13.2 range or even below that and closer to there. But nonetheless, Buffett seems to find this still attractive. Their financials on an annual basis are a little bit shaky. We can see that in 2015, they had negative net. Again in 2019 and 2020. But they do fight back fairly quickly, and it doesn't look like they stay down very long. On a trailing 12-month, we can see that they have risen and fallen alongside their revenues, and it looks like they have paid down some of their debts, but we do see significant share buybacks here. Looking at the DCF, for earnings per share, there's about 14% growth priced in for the next 10 years annually to equal roughly a fair value of what we're at today. And we can see that their earnings per share are a little bit sporadic. Sometimes they're positive, sometimes they're negative. So we don't really have those averages. Although 14% growth is not a seriously high amount of growth to be pricing in, but it is a little bit harder to estimate what it could be growing at and what could be fair for earnings per share. Looking at free cash flow, in the last 10 years, there's no average. In the last 5, they've averaged 44%. In the last 3, they've accelerated to 86. So seeing what's currently priced in, there's just about 6% priced in for free cash flow over the next 10 years. And I think that seems very reasonable, especially considering what they've grown at over the last 5 and 3 year averages. Although 10 years is a long time to be estimating. But even if they can grow at 10% over the next 10 years, which is to me seeming very conservative, then they could have a fair value of $82 or $83, whereas they're currently at 63. So to me, it looks like Buffett is betting on a very deep value play. He could be hedging against war in the Middle East or global war that would dramatically increase the price of oil. Occidental also seems to have large reserves on America's homeland. And there's also that slight chance that those carbon credits will become seriously valuable in the future if this 2030 agenda of net neutrality comes into play. So it seems to me like Buffett is trying to play it safe and buy something with very high cash flows that trades arguably fairly cheap and hedge himself in the event that there's war breaking out or some chaos in the near future. But that being said, if you like these type of videos, leave a like, subscribe if you're not already, and let me know down below if you're here for Tesla or Oxy, what you think of either company, and I'll see you next time.